Let's talk about income taxes in the Philippines. 90% of national government revenues come from taxes in general. As provided for by the Constitution, all taxes emanate from Congress and takes effect upon signing into law by the President. Most taxes are collected by the Bureau of Internal Revenue and Bureau of Customs. Income taxes are collected by the Bureau of Internal Revenue and have historically comprised 50 to 60% of total tax revenues. But with the proposed CREATE bill that reduces corporate income taxes, in 2021, the share of income taxes will go down to almost 40%, and for the first time in at least 20 years, will be overtaken by consumption taxes on domestic goods and services like VAT and excise. For the past 20 years, corporate income taxes have been the top source of income taxes, having a share of almost 60%. With a proposed reduction in corporate income taxes, the share is expected to drop to 40% in 2021. By that time, individual income taxes will rise as the top source of income taxes with a share of 50%, up from its historical average share of 40%. The Philippine corporate income tax rate of 30% is higher than regional peers, but actual collection as a percent of GDP is much lower, pointing to several loopholes in the corporate tax system. The CREATE bill proposes to lower corporate income tax rate to 20%, to be at par with the regional average, and to streamline tax incentives to minimize loopholes and improve tax administration. Tax incentives in 2019 totaled more than 500 billion pesos. 75% are mostly from VAT and duty exemptions, while 25% are from income tax incentives. Majority of these tax incentives are administered by the Philippine Economic Zone Authority, Clark Development Corporation, Cooperative Development Authority, Board of Investments, Subic Bay Metropolitan Authority, and other smaller economic zone authorities. By industry, top recipients of incentives are manufacturing, particularly electronics and semiconductors, services, particularly BPOs, energy, tourism, and low-cost housing. Advocates of tax incentives argue that these are necessary to attract foreign investors that can opt to set up in other more competitive destinations. For critics, however, some tax incentives are merely corporate giveaways for industries that are well connected. The Philippine income tax system for compensation earners was recently revised as part of the first package of the Comprehensive Tax Reform Program, more popularly known as Train 1, to reduce the number of brackets to 6, increase the levels of the brackets, and adjust the tax rates. With the increasing need to shore up government revenues, there are some who are pushing for an additional bracket for higher income levels to be charged at a higher tax rate. The last set of income taxes are taxes on passive income, usually from investments in deposits, debt instruments, and stocks and equities. The existing system sets multiple rates ranging from 10 to 20%, depending on the type of investment. Government is seeking to simplify the multiple rates at a unified rate of 15%. Advocates of lower tax rates on passive income argue for the need to benchmark with regional peers to attract more financial investors to expand the country's debt and equity markets. Critics, however, point out that lower rates for passive income tend to benefit the wealthy, while majority of workers who only earn compensation income end up paying higher income tax rates.